Welcome to Creamer Media's Resources Watch, a weekly video roundup of the events and people making and shaping the news in the mining industry. This week, AngloGold is using its multi-content discovery strategy to hit its 5.5 million ounces a year target. Nationalisation could contribute to social transformation if managed well, and Goldfields spurns the novel gold-linked dividend idea and rejects quarterly dividends. Gold major AngloGold Ashanti is using a promising low-cost strategy of discovery and development to attain its stretch target of 5.5 million ounces of gold a year by 2014.
We've got great new prospects in Guinea, in the DRC with the two new projects there, in Brazil with conribute in situ. We've got a couple of projects in Argentina. We've got some wonderful projects in Colombia, two major projects, and all of them are doing well. We're getting continuing exploration intersections and results, and as well as that, we're well into the construction of Tropicana in Australia. So the portfolio is looking very good, and we're looking very strong, I think, for our target of 5.5 million ounces by 2014.
Resource nationalism is by definition not a bad idea, as it is an accepted method for governments around the world to extract sufficient rent from the limited resources they have, says investment banker Rothschild South Africa CEO Martin Kingston.
Too much attention perhaps has been given to the word nationalisation. If you look at what's happening around the world, resource nationalism is actually very much accepted as a necessary way for the state to extract appropriate rent from resources that by definition are limited in lifespan, and maybe we need to think about those definitions. The reality is that these resources need to be exploited for the benefit of all of the citizens of South Africa on a sustainable and viable basis over the short, the medium and the long term. There are, however, significant constraints that need to be recognized in maximizing that potential. And that's particularly when set against the specific challenges that confront South Africa, including poverty, unemployment, access to basic social services, the need to uphold human rights and dignity, and clear and growing inequality within the country.
Gold major Goldfields won't adopt the novel gold price-linked dividend payment initiative that has been introduced in North America to reward shareholders optimally at a time when gold is on center stage.
Look, gold-linked dividends are quite interesting, and I understand why companies are trying to do it. You know, they're trying to create a fungibility, if you like, back to the gold price. But the bottom line is, if the gold price goes up, you make more earnings. We pay dividends out of earnings. We don't pay dividends out of the gold price. And if earnings go up, clearly we'll pay more dividends. If you look at our dividend yield history and our dividend payout history, we're right up there. And in fact, over the last 3 to 4 years or so, we've paid out somewhere between 27 and 32% of our earnings as dividends. So if we continue doing what we're doing, we're going to be rewarding shareholders, and we'll be very competitive on dividends.
For mining news as it breaks, stay logged onto miningweekly.com and register for our free daily newsletter.